Welcome to the Spokane housing market update. It's February 2023, the Fed has upped rates again, mortgage applications actually made the news, and the buyers seem to be back. So as always, let's take a deep dive into the data and see what's actually happening in the housing market both nationally and locally here in Spokane. My name is Phil Wells, I'm a real estate agent that likes to keep up to date with the market, and I want you to be as informed as possible too. In this video, we're going to get a national picture of what's going on by looking at pending home sales, mortgage rates, and mortgage application rates. We'll then compare what's happening nationally with what's happening here in Spokane and see how they differ or see how similar they are. We'll then move on to look at some news articles that have stood out to me this month before trying to piece it all together at the end and figure out if we can summarize the market as we see it right now in February 2023. So let's get into it. Looking first at national pending home sales for existing homes. Just a note on these figures and the figures throughout this entire video, they are the latest that are available, but there is often a lag when it comes to reporting data, particularly at the national level. So for example, the pending home sales we're about to look at, detailed pending home sales from December 2022. Contract signings were up in December, breaking 6 consecutive months of declines by increasing 2.5% month on month in December 2022. Year over year, contract signings declined 33.8%, which represents 19 consecutive months of year-over-year sales declines. In the Western region, where I'm based, sales increased 6.4% in December, but decreased 37.5% from December 2021. Here's what the National Association of Realtors chief economist had to say about December's pending home sales. The recent low point in home sales activity is likely over. Mortgage rates are the dominant factor driving home sales, and recent declines in rates are clearly helping to stabilize the market. The new normal for mortgage rates will be in the 5.5 to 6.5% range. So a positive note there on month-over-month sales, breaking 6 months of declines, but they are still massive year-over-year sales declines. We're talking about millions fewer transactions taking place this year than last year. So if you are an investor, a cash buyer, or just a regular buyer that's been sat on the sidelines waiting for their time to strike, then know this: when rates were low, the market was awful. If you can avoid competing in that sort of environment, then you absolutely should. People were bidding 10 to 20% over list price, waiving all sorts of contingencies, and still losing 5, 10, 15 offers back to back. I was there, it wasn't fun for anyone. One thing for you to think about is that those people that wanted to buy homes then haven't simply disappeared. And now we're starting to talk about pent-up demand and buyers coming back into the market as rates make more and more sense. We'll talk about this a little bit more later on. Right now, you have the best window of opportunity at any time in the last couple of years to actually get the property that you want under contract, and if you're willing to stomach the high rates right now in the anticipation that you'll be able to refinance in the future, then you could find yourself in a really strong and comfortable position both in terms of home equity and an affordable mortgage payment. Ask yourself this question: would you rather be refinancing when rates are at 3% or scrambling around trying to find a home? Let's move on and look at mortgage rates. Obviously, the majority of people don't have hundreds of thousands of dollars just lying around to buy a home, so the majority of people are buying with the aid of a mortgage. So to keep an eye on mortgage rates gives us a really good idea of what direction buyer demand is likely to head in. Rates are also in a constant state of flux, so by the time they hit the headlines, they're already out of date. The best we can do is track trends, and that's what we'll do right now. Sticking with December for a second, mortgage rates at the start of December were at 6.29%, and by the end of December they'd risen to 6.54%. The most recent rates that I could see have dropped since the end of December to 6.04%. So we're getting very, very close to that 5% range. And in fact, if you're using a different sort of loan than the conventional loan, for example, a VA loan or an FHA loan, they're already in the 5% range. I just mentioned before that I believe there is pent-up demand, and as these mortgage rates come back down, more buyers that were sat on the sidelines will enter the market. They still want and need homes, and they will be back. Remember too that home prices have actually been falling since their highs in April-May time. So while your rate may suck right now, you are paying less for a home, and you're more likely to actually get the home that you want than your counterparts this time last year. And when you are able to refinance to a better rate, I think with the benefit of hindsight, you'll think that it was a good idea to buy right now. Don't forget about the buy-down mortgage products out there, like the 2-1 mortgage, that will allow you to have a rate 2% lower than market in the first year and 1% lower in the second year. There are also adjustable rate mortgages out there you may wish to explore. I'm not the biggest fan of these, but they are out there and they work for some people. Sticking with mortgages and looking at mortgage applications. I always say this is a huge leading indicator for the overall housing market because it doesn't matter what rates are, it matters how many people are actually applying for loans. And I was extremely excited to see mortgage applications actually make national news recently. I was blown away. Mortgage rates are the absolute least sexy data point when it comes to the entire housing industry. But they're so important to track. People apply for mortgages before they close on homes. That's just a fact. That's just how things are ordered. So if we see a spike in applications, we're likely to see a future spike in closed sales. So in a way, you can predict the future by looking at mortgage applications. The Mortgage Bankers Association publishes the results of surveys weekly to gauge how applications are shaping up, so let's focus on December's headlines quickly to get a picture of what's been happening. Survey for the week ending December 2nd, applications were down 1.9% week on week. Survey for the week ending December 9th, applications were up a healthy 3.2% week on week. For the week ending December 16th, applications were up 0.9% week on week. They then had some time off for Christmas, so they reported 2 weeks together when they came back, and they were down 13.2%, which you'd sort of expect when we're doing week on week comparisons. No one is really shopping for homes over Christmas and New Year. Fast forward a few weeks, and we see mortgage rates drop 0.5% to right around the 6% mark, and we get a 27.9% increase in mortgage applications. That goes to show you that there are people out there still wanting to buy homes, and they know how much home they want to buy, and they know what mortgage rate they need to be able to afford that sort of home. The 5 to 6% mortgage rate range can be a very competitive market. For reference, I bought a home last year at 5.5% mortgage rates, and it was a competitive market then for me. I had to bid on, I believe it was 3 homes at the time to actually get the one I wanted under contract. And I think right now that 5 to 6% range is when we're going to start seeing a lot of buyers coming back into the market. And we're nearly there. Looking now at my local market, Spokane. As I mentioned at the start, it's important to see what the national market is doing and then compare it to what's happening locally, because Spokane isn't an economic island. If it's behaving differently to how the national market is, we need to understand how it's moving differently and why. These are actual sales for January, so be mindful that we're comparing locally closed sales in January with national pending home sales for December. Given that it takes around a month to close a transaction, it's a fairly accurate comparison, but it's not perfect, so just bear that in mind. Sales were down 35.4% year over year, which is more pronounced than the national year over year decrease of 33.8%. But still broadly in line with what's happening nationally, and Spokane is performing better than the overall Western region's year-over-year decline of 37.5%. Median home prices are down on a year-over-year basis for the second month in a row. It's worth noting though that home prices haven't just started falling. Within the past year, they went up to a median home price of $450,000 here in Spokane in April-May time, and have since descended to their current levels of $365,000. So while it may look like only a $10,000 drop, if you analyze only year-over-year figures, when you zoom in, there's a trend downwards that's been happening for a while now. In fact, the full picture is that home prices have dropped $85,000 here in Spokane since their highs in April-May time, which represents an 18.8% decline since their highs. So what I've been saying throughout this video about you being able to get a great purchase price right now and then combining it in the future with a great mortgage rate is true. Even if you pay list price right now, you're still likely getting a good deal. Regardless though, if prices continue to fall, the macro picture is clear. Inflation is coming down, the Fed funds rate is close to peaking, and mortgage rates keep falling despite what the Fed does with its Fed funds rate. When the Fed is able to drop its rates, mortgage rates are going to plummet, and these prices are going to come back. It's just a matter of riding it out right now. Inventory is up to a 2-month supply, but don't let that 148.9% fool you. As you can see, supply is measured at current demand levels. If we had the same transaction volumes as last year, i.e. the same demand, we'd have just over a 1-month supply, which illustrates the point further. What I said earlier in this video, the low inventory phenomenon isn't over. It's just been masked by high interest rates, which is artificially dropping buyer demand. I believe that the low inventory phenomenon will really raise its ugly head when rates come back down and more buyers are able to enter and re-enter the market. New listings are up 7% on a year-over-year basis, which is actually good news. I wonder if the sellers that have felt trapped for the last few months when rates were over 7%, who were actually unable to sell their homes, are now trying again now that rates are in the low 6% range. So overall, this means that Spokane is tracking the rest of the nation pretty closely. I think it's fair to say that Spokane is not behaving like an outlier in any of the metrics that we've looked at, so you can expect macroeconomic news to trickle down and impact the Spokane housing market the same way that it impacts the broader housing market. Now I wanted to touch on a few headlines that have stood out to me this month. There's a lot going on as always, so I just want to draw your attention to some headlines and cover them briefly. If you want to read the articles in their entirety, as always, I always publish my references in the description to this video. So let's talk about inflation and the need for future Fed funds rate hikes. Inflation in December was at 6.5%, which represents 6 consecutive months of month-on-month declines in the rate of inflation since its high in June of 9.1%. It's projected that inflation in January will be 6.3%, so not a major step down, but it's going in the right direction. So good news on inflation there. Can interest rates come down? Well, the answer is no, unfortunately. Overall, inflation is down, but that's not what the Fed really looks at when it's making its rate decisions. It looks at the CPI, the Consumer Pricing Index, which unfortunately in December was up 0.4%. Overall, we have good news on inflation, but there are elements that are still heading in the wrong direction. As a result, the Fed is still bumping rates. We're up another 0.25% now to 4.75%. And the Fed is talking about continuing to increase rates into the future. This isn't new though, and it isn't a change in direction. Last month we talked about many experts are predicting the Fed funds rate to be around the 5.5% mark before the Fed accomplishes its goal of defeating inflation and rates can begin to come back down. We also discussed last video that we believe that the Fed is being pretty overly cautious here, given that they were caught napping when inflation first raised its ugly head. Jerome Powell is quoted as saying, "While recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path." He also said, "We can now say for the first time that the disinflationary process has started." So, as always, slightly contradictory messages there from the Federal Reserve, but it's nice to see at least a tone of optimism after all the doom and gloom we've been hearing from the Fed for the past few months and even the past few years. So overall, pretty good news there on inflation. Things do seem to be trending down, and the Fed is behaving how we expect it to behave, so good news there too. I follow a lot of housing-related accounts on Instagram, which incidentally is where I'm most active. If you don't already follow me there, please go and give me a follow now. And one of the quotes that caught my eye this month was from David Stevens, a former assistant housing secretary. He said, "So be advised, this may be the one and only window for the next few years to get into a buyer's market." I have been saying it for a while. This is an artificial buyer's market, and it's caused by one thing: the Federal Reserve funds rate, which in turn is caused by inflation. So as we see inflation begin to come back down, the Fed funds rate will in turn come back down. It might have to go to 5.5% like the experts are predicting before it can come down, but when it does, we will see mortgage rates plummet and a lot of buyers come back into the market. So think twice before you wait for 3% rates. Now you're probably wondering if anything interesting happened this month, or whether it's just all heavy news about inflation. Well, 42% of home sales in Q4 resulted in some sort of buyer concession. All the more reason to buy now rather than wait for 3% rates to come back. You won't be getting a seller credit for that old furnace when there's 10 buyers knocking at the seller's door when rates are at 3%. And Spokane might be getting a zip line across the Spokane Falls to celebrate the Expo 74 anniversary. For those of you that don't know, the 1974 Expo is the reason that the Spokane Riverfront Park looks as cool as it does. It used to be a rail yard, now it's one of the best city centre natural areas anywhere. Now let's try and piece all this information together and see what it means for you. The big news is that inflation is trending down. We're on the 6th consecutive month of declines there. Unfortunately, 6.5% inflation is still way too high, and the Fed isn't taking its foot off the brake just yet. Many experts predicted that the Fed funds rate will continue to rise from its current 4.75% up into the mid 5% range before the Fed accomplishes its goal and can begin to take its foot off the brake. Nationally, the most recent pending home sales report for December seems to show that falling mortgage rates are having a direct impact on home sales, though we are still down massively on a year-over-year basis. In terms of Spokane specifically, sales are down and we continue to have low inventory. Prices here in Spokane are down 2.7% year over year, but are actually down $85,000 from their highs in April-May time of 2022, which represents an 18.8% decline since their highs. If you're a seller right now, know that not every buyer is back. But as rates descend into the 5% range, more and more are coming back. In fact, every 0.1% brings people back into the market. So you can sell your home now. It's not the best time to sell, but at least you're not stuck in your home like people were when mortgage rates were at 7%. I'm even hearing reports of multiple offers in more densely populated markets like Seattle. And even here in Spokane, we're seeing new listings of desirable homes get multiple viewings the first couple of days, and even 1 or 2 offers in the first week. We're by no means in bidding war territory yet, but buyers are certainly coming back. If you're a buyer, your window is closing. This buyer's market is artificial. I've been saying it for a number of months now. If rates suddenly became 3% overnight, we would be in an extremely strong seller's market. So I'm more convinced than ever that we're approaching the bottom of the current market cycle. As inflation gets tamed, the Fed can begin to think about dropping its interest rates, and when that happens, mortgage rates are going to plummet, and those buyers that have been waiting on the sidelines are going to come roaring back. Which is going to make it extremely uncomfortable for you if you're able to buy right now, but are just holding off for 3% rates. Remember, we still have low inventory. That phenomenon hasn't gone away, it's just been masked by low interest rates. So while you'll be able to afford more home at a 3% interest rate, your chances of actually connecting with the home will diminish substantially. Too many people in the last seller's market bought just any old home because they were able to, instead of buying the home. You don't want to be in this position. Those people are likely going to have to sell soon to actually get the home that they truly want. So I maintain there is still a window of opportunity to get a good purchase price. Home prices are down here pretty substantially from their highs in April-May time. And in the future, combine that good purchase price with a good mortgage rate. And if I sound like a broken record, I apologize. The housing market does move slowly. It changes direction like a cargo ship would, not like a jet ski. So the same conditions can be true for many months or even years. That's it for this video. If you gained from this video, please like and subscribe. That tells YouTube that I'm doing a good job and they'll show this video to more people. If you are looking at buying or selling in the Spokane area, then please reach out to me. Give me a call, shoot me a text, send me an email, or find me on Instagram or Facebook and send me a direct message. And I would be honored to work with you. Until the next one, my name is Phil Wells and thank you for watching.